3 months ago, a man named Marcus walked into a mortgage lender's office with a credit score of 621. The loan officer gave him the news he expected. He could still qualify for a mortgage, but the interest rate would be expensive. On a $350,000 home, even a small difference in the mortgage rate can mean tens of thousands of dollars more in interest over 30 years. Marcus asked if he could have about 90 days to improve his credit before locking the loan. The loan officer said yes, but warned him not to expect a miracle. Credit scores can take time to improve. About 3 months later, Marcus came back with a much stronger credit profile. And this is where the story gets interesting. Marcus did not dispute accurate information. He did not use fake fraud claims. He did not discover some illegal credit trick. He learned how a few real parts of the credit scoring system work. Things like authorized user accounts, reported credit card balances, credit limits, and rapid rescoring during some mortgage applications. Now, I need to make something clear before we continue. There is no strategy that guarantees a 100-point or 140-point increase. FICO itself says the effect of any one action depends on everything else in your credit report. Two people can make the same move and get very different results. But these tools are real, and most people do not understand how to use them. Today, I'm going to show you exactly how they work. Because everything you have heard about building credit slowly over time is partly true. Pay on time. Keep balances controlled. Do not open too many accounts. Let your history age. That is good advice, but it is incomplete. There are parts of your credit profile that can change much faster than your account age, and understanding those parts can save you serious money before a mortgage, car loan, or major credit application. Let's start with the first one. Authorized user accounts. To understand why they matter, you first need to understand how FICO scores are generally calculated. Payment history makes up about 35%. Amounts owed, which includes utilization, about 30%. Length of credit history about 15%. New credit about 10%. Credit mix about 10%. Those are general percentages, and FICO says their importance can change depending on the person's full credit profile. Now here's where authorized user accounts become interesting. Imagine your mother has a credit card she opened 20 years ago. She has never missed a payment. The balance stays low. The limit is high, and the card issuer reports authorized users to the credit bureaus. She adds you as an authorized user. You do not even need to carry the physical card. If the issuer reports that authorized user account, the account history can appear on your credit report. That can include its age, payment history, balance, and limit. The CFPB has documented that authorized users can receive the history of the account on their credit record. While FICO explains that newer scoring models may give authorized user accounts less weight than accounts where you are the primary borrower. That last part matters. You are not borrowing somebody's entire credit score. If your mother has an 820, you do not automatically get an 820. You are adding information from that specific account to your file. If the account is strong, it may help. If the account has high utilization or missed payments, it can hurt. FICO specifically says both positive and negative authorized user information can affect your score. This is what Marcus learned. His own credit file was young. Only a few accounts, not much history. A close family member had an older card with clean payment history and low utilization. Marcus was added as an authorized user. When the account reported, his file became stronger. Did that one account guarantee a certain number of points? No, but for someone with a thin or young file, an older, well-managed authorized user account can sometimes have a meaningful effect. Now let me give you another example. Jason is 24. His credit score is 589. He made mistakes in college, a few late payments, a maxed out store card. Now he wants to finance a used car, and the offers he is getting are expensive. His grandfather has 2 old credit cards. Both have years of clean history, low balances, high limits. His grandfather adds Jason as an authorized user. He does not give Jason the cards. He simply adds him to the accounts. Once those accounts report, Jason's credit file may now show that additional history. That does not erase Jason's old late payments. It does not make his real negative information disappear, but it can strengthen other parts of the file. And if his score improves enough to qualify for better financing, that can save him real money. That is why authorized user status should be treated as support, not as a replacement for building credit in your own name. FICO specifically says authorized user accounts may carry less weight in newer scoring versions, and building primary accounts of your own is still important. So if you want to use this strategy, here are the details that matter. First, the account should be in good standing. Clean payment history is much better than an account with recent late payments. Second, lower utilization is generally better. Third, an older account may be more useful to somebody with a short credit history. Fourth, make sure the issuer actually reports authorized users to the credit bureaus. Do not assume. Verify. And fifth, understand the risk. If the primary cardholder suddenly runs the card close to the limit or starts missing payments, that information can affect you too. So choose carefully. Now, is this allowed? Yes, authorized users are a normal part of the credit card system, but do not confuse allowed with guaranteed score boost. The scoring model still looks at your entire profile. Now let's move to the second strategy, utilization. This is where a lot of people lose points without even realizing it. Imagine you have a credit card with a $3,000 limit. You spend $2,000 during the month. You pay the full balance by the due date every month. So in your mind, you are doing everything right. And from an interest standpoint, you may be. But if the issuer reports that $2,000 balance before you pay it down, your credit report may show high utilization. $2,000 divided by a $3,000 limit is about 67%. And high utilization can hurt your FICO score. FICO says the balance on your credit report usually reflects what the lender reported, often the balance from your latest monthly statement. This is why the statement date and the due date matter. Most card issuers generally report once a month around the statement closing date. Then, your payment due date comes later. So imagine your statement closes on the 20th. Your payment is due on the 15th of the next month. Instead of waiting until the due date, you pay most of the balance before the statement closes. Now maybe the statement reports $100 instead of $2,000. Same card, same monthly spending, same person. Very different reported utilization. And reported utilization is what the scoring model sees. Now you will hear people online say 30% is the magic number, or exactly 1 to 3% is perfect. Be careful. FICO says there is no single perfect utilization percentage for everyone. Generally, lower utilization is better, and FICO notes that keeping it under 10% can be helpful for many consumers. But the exact impact depends on the full file. So the lesson is not, you must report exactly 2%. The lesson is, do not let a high statement balance make your credit look more maxed out than your finances really are. And no, you do not need to carry interest-bearing debt to build credit. You can pay your statement balance in full and still manage what balance gets reported. This brings us to the third strategy. Credit limit increases. Utilization is a ratio. Balance divided by limit. So there are two ways to improve the ratio. Lower the balance, or increase the available limit while keeping spending the same. Imagine you owe $2,000. Limit $5,000. Utilization 40%. Now imagine your issuer increases the limit to $10,000. Same $2,000 balance. Now utilization is 20%. Nothing about the debt changed. The ratio changed. But before you start requesting increases on every card you own, ask the issuer one question: will this request require a hard inquiry? Some issuers may review your credit when deciding a limit increase. The process is issuer specific. Do not blindly assume it will always be a soft inquiry. And the goal is not to get a bigger limit so you can build a bigger balance. If the limit doubles and your spending doubles, you fix nothing. The benefit comes when available credit grows while the balances stay controlled. Now let's talk about the fourth strategy: old accounts. This is where the original advice you often hear gets confused. People say never close any account because closing it destroys your average age. That is not exactly how FICO works. A closed account can continue to appear on your credit reports and can still count toward the age of your credit history while it remains there. Closing a newer card does not normally make it disappear from your average account age overnight. The more immediate problem can be utilization. Imagine you have two cards. Card 1, $10,000 limit. Card 2, $5,000 limit. You owe $2,000 total. With both open, you have $15,000 of available credit. If you close the $10,000 card, your available credit can drop sharply. Now the same $2,000 balance is working against a smaller total limit. Your utilization can jump. That can hurt. So account management should not be keep everything forever, or close new cards to improve average age. It should be, does this account cost me money? Does it have an annual fee? How old is it? How much available credit does it give me? Will closing it raise my utilization? Is it still useful? Make the decision with the full picture. Now, the fifth strategy becomes very important when you are already in the mortgage process. Rapid rescoring. Most consumers do not know about this because you usually cannot order it directly yourself. A mortgage lender can sometimes request a rapid rescore when recent information on your credit report needs to be updated quickly. Imagine Marcus is applying for a mortgage. His credit card reports a $7,000 balance. He pays the balance down dramatically. Normally, he might wait for the lender to report the new balance in its regular monthly cycle. But time matters. His mortgage is already moving. A mortgage lender may be able to request a rapid rescore using documentation of that recent account change. Experience says this process can update qualifying credit report information within days instead of waiting weeks for the normal reporting cycle. Important. Rapid rescoring does not magically add points. It does not erase accurate negative information. It simply helps get verified recent changes reflected faster. If lowering the balance helps the score, the new score may improve. If it does not, rapid rescoring cannot force it to. That distinction matters. Now let's talk about the mistakes people make. Mistake number 1, choosing the wrong authorized user account. Do not get excited just because the account is old. Check the balance, check the limit, check the payment history. An old card at 95% utilization is not automatically helping you. An old card with late payments can bring negative information with it. Mistake number 2, opening a bunch of new credit at the same time you are trying to optimize your score. New accounts can lower your average account age. Hard inquiries can also reduce a FICO score by a few points depending on the profile. FICO says inquiries stay on credit reports for 2 years. Although FICO scores only consider inquiries from the previous 12 months. So if you are preparing for a mortgage, this is probably not the time to open 3-store cards because somebody offered you 15% off. Mistake number 3, ignoring reported utilization. You can pay in full every month and still have high utilization reported if the timing is wrong. Know the statement closing date. Know what balance is being reported, then manage it intentionally. Mistake number 4, thinking one billing cycle should permanently fix your score. Credit scores move as the information on your reports changes. Your score can go up, it can go down again. A low utilization month does not protect you forever if the next statement reports a maxed out card. Mistake number 5, treating authorized user status like your whole credit profile. You still need accounts where you are responsible. You still need on-time payments. You still need controlled balances. You still need time. Now let's build the action plan. If your score is below 650, start with the report itself. Not a hack, not a trade line, the reports. Experian, TransUnion, Equifax, look for accounts that are not yours. Wrong balances, incorrect late payments, duplicate debts, closed accounts reported incorrectly. If information is inaccurate or incomplete, you have the legal right to dispute it with the reporting company and the company that supplied the information. And right now, consumers can access free weekly credit reports through annualcreditreport.com. Then look at your balances. If your cards are reporting 70%, 80%, or 90% utilization, lowering those balances may be much more important than chasing some complicated strategy. If you also have a trusted family member with an old, clean, authorized user account, that may help support a thin credit file. But do not expect somebody else's account to erase your own problems. If your score is somewhere between 650 and 720, now you may be in more of an optimization phase. Look at utilization, payment timing, available limits, unnecessary new inquiries, report errors, and whether a strong authorized user account makes sense for your specific file. If you are above 720, you may already qualify for many strong products. That does not mean every lender gives the same terms. Mortgage lenders use different score versions, loan programs, debt-to-income rules, down payments, reserves, and underwriting standards. So do not obsess over, I need exactly 780. Prepare the whole borrower. And if you are already inside a mortgage application and a recently paid down balance has not updated yet, ask the lender whether rapid rescoring makes sense. Now here is the deeper lesson underneath all of this. Your credit score was built to help lenders measure risk. It was not built to tell you whether buying something is a smart financial decision. A 780 score does not mean you should finance the $70,000 car. A 760 score does not mean the mortgage payment fits your life. It simply helps lenders evaluate the credit information on your reports. FICO describes its score as a tool that helps lenders estimate credit risk using things like payment history, debt levels, account age, new credit, and credit mix. That is why learning the rules matters. Not because banks are secretly hiding some magic button from you. Because if you do not understand how the reported information affects the score, you can make expensive decisions without realizing why the lender is pricing you the way it is. Marcus did not need a fake loophole. He needed to understand the file. Authorized user accounts could help strengthen a thin history. Lower reported utilization could improve the amounts owed side of the profile. Higher limits could help utilization if spending stayed the same. Keeping useful older accounts could protect available credit. Rapid rescoring could help recent verified changes appear faster during the mortgage process. And genuine reporting errors could be disputed through the proper process. None of these actions guarantees a 140-point increase. That is the part people selling credit secrets usually leave out. Your starting profile matters. The scoring model matters. The bureau matters. The lender matters, but the mechanics are real. And once you understand them, credit becomes much less mysterious. So here's what I want you to remember. Do not chase points. Build the profile. Pay every account on time. Keep revolving balances controlled. Check what is actually reporting. Build primary credit in your own name. Use authorized user status carefully if it genuinely helps. Ask before requesting limit increases. Do not close accounts without understanding the utilization effect. Review all 3 reports. Dispute only real inaccuracies. And if you are preparing for a mortgage, do all of this before the lender tells you what your credit mistakes are going to cost. Because bad credit asks, can you get me approved? Strong credit asks, what rate are you offering? And a prepared borrower asks one more question, can anybody beat it? That is where the real power is. Not in a loophole, in understanding how the system actually reads you, and using that knowledge before the next bank gets to put a price on your credit.